Matt, hey.
Neil, how you
Yeah,
doing?
doing great, man. Nick, how's it going?
Doing great. Thanks for having us.
It's my pleasure. We're very happy to have you. I am going to stop hamming it up. I am going to hand it off to you guys for our session on global opportunity for crypto and stablecoins.
Okay, great. I'm going to share my screen. We got some slides for you all. So first of all, thank you for the opportunity to present. Very excited to share our thoughts with you all. And we are going to do this. So our topic today is the global opportunity for crypto and stablecoins. We're going to mostly focus on stablecoins, as we call them, crypto dollars. So very briefly, a quick about us. So I'm Nick Carter. I'm one of the GPs at Castle Island Ventures. Matt, you want to chime in?
Yeah, and I'm Matt Walsh. It feels like we're doing a podcast, Nick. We'll try to keep it conversational. So we started Castle Island about 2.5 years ago. We're an early stage venture fund based in Cambridge, Massachusetts, now based from our homes and WeWork. And we focus largely on blockchain infrastructure companies. So this stablecoin topic is very near and dear to our heart because we're investing in a lot of companies that are supporting some of this infrastructure, including BlockFi. And prior to this, Nick and I were over at Fidelity Investments, where we managed a small fund for Fidelity and made investments on their behalf, and also led R&D initiatives in the blockchain space. And Nick started Coinmetrics, which is a data platform that does a lot of work with stablecoins. So excited to chat with you all today.
Yeah, and feel free to chime in with questions. I think most likely we will have some time to take questions at the end. So we wanted to talk about stablecoins or crypto dollars. The market structure of the industry is really changing quite dramatically in some unexpected ways. I think ways that Satoshi would have never forecasted. The main takeaway that we wanted to leave you with today was that cryptocurrencies, and in particular, to an increasing extent, crypto dollars, stablecoins, are effectively a global liquidity pool that unite almost the whole world in a really seamless and frictionless way. And that has a lot of really interesting implications, which we'll get to in this talk. But so imagine the exchanges, which we have on our stylized map here, as effectively crypto banks. And these are off-ramps from local sovereign currencies into these global liquidity pools consisting of Tether, Bitcoin, Ethereum, other cryptocurrencies. So they are uniting people into these global clearinghouses for value. And we will demonstrate what this means in a practical sense. So it's really impossible to look at the numbers and not be impressed. I mean, we call them crypto dollars. People call them stable coins. Their float this year in 2020 has grown from 5.8 billion to about 20 billion today. It was 19 billion when we made the slides, pretty much 20 billion today. They've added this year, every single day, on average, $50 million. So the growth is really preposterous. It's gone from effectively zero in early 2017 to 20 billion in monetary base today. So some people kind of overlook crypto dollars and they're more excited about other features of the crypto industry, some of the interesting opportunities in DeFi, but we're just focused on the payments infrastructure, at least for the purposes of this talk. And crypto dollars are the biggest phenomenon here. And then within that crypto dollar sector, Tether, very controversial project. Tether has effectively dominated, historically, it's been about 75 to 85% of the whole sector. Although its market share is declining a little bit recently, the other crypto dollars, most of them are onshore, so they're issued by administrators that have relationships with the U.S. banks. So USDC, TrueUSD, Paxos, those are onshore issuers. So those would be distinct from Tether, which is issued by a network of offshore banks. And that's really critical in distinguishing the projects because that tells you a little bit about the likelihood of oversight and regulation. And of course, Tether is kind of at war with the New York Attorney General, the New York regulators right now. They're trying to clamp down on it to a certain extent. So far, Tether has managed to remain pretty independent, which some would say is part of the value proposition, that it's largely independent of the US financial system, but it still gives you access to dollars. And one last stablecoin or crypto dollar we wanted to call out would be DAI. DAI, historically at least, was issued in a very different way from these other ones. It was issued against a risky, liability-free crypto collateral, as opposed to being issued against bank dollars. So for most of these stablecoins, they're convertible into fiat currency, and they're redeemable for dollars that are in a bank account. So there's no risk transformation that's occurring. But with DAI, there is, you take the risk profile of Ethereum and you transform it by over collateralizing it into something that has the risk profile of dollars. And so that's less capital efficient, but in theory, it's more decentralized and it's more resistant to control. But DAI is still a relatively small part of the market. So we thought that we'd offer a definition for you all. So crypto dollars we define as cryptographic tokens which circulate on public blockchains. And the objective is to track the return of sovereign currencies, primarily the dollar. Now, they don't always do that perfectly. In fact, Tether historically lost its peg for an extended period, and DAI has traded at a premium for long periods. So we thought that if we included in the definition that they are always convertible or precisely equivalent to a dollar, that would be a pretty overly restrictive definition. But so they have some really, really important characteristics which totally distinguish them from other digital dollars. And this is one of the really key points. A PayPal dollar, it lets you do a totally distinct set of things that a crypto dollar like Tether or DAI lets you do. And importantly, crypto dollars are digital bearer instruments. So that means that the owner, the person who can unlock that, unlock that token and can spend it on a public blockchain, they are presumed to be the holder. They're presumed to be the owner. So they're a bearer instrument in the same way that cash, physical cash, is a bearer instrument. So the objective is to take those cash properties and convey them into a digital context. The other really important thing is that any developer can permissionlessly build tools to interact with crypto dollars, which is radically new. I mean, if you wanted to build financial service products in this country, you need a variety of oversight from regulators. You might need a bank charter. This is a completely different sandbox where so far this is permissionless element. You can just deploy contracts and users can start to engage with them. And importantly, users can also make peer-to-peer transactions without much oversight and without much restriction. There are some caveats. I mean, some of the crypto dollar issuers do occasionally freeze user accounts. So it's not a truly completely decentralized and permissionless experience, but so far there's not that much oversight. So a couple of key characteristics, but I don't know if you want to chime in here.
Yeah, so historically, if you look at just what are the blockchain platforms that are enabling some of these stablecoins, these crypto dollars to exist, it's really started with Bitcoin. And so the Omni protocol was established on top of Bitcoin, and this was where Tether originally was operating. So 100% of Tether a couple of years ago was on Omni. Since a lot of that activity has moved over to Ethereum on the ERC20 standard. And really the benefit of operating on the ERC20 standard as opposed to Omni is really just around ERC20 being a common infrastructure that a lot of the exchanges and the custodians have to offer. Now, what's interesting is that we're starting to see alternative platforms emerge. And our thesis here is that it's really as a result of some of the fee pressure on Ethereum. As Ethereum struggles to scale and as the fees just to use the network start to increase, we're starting to see the escape valve of other blockchains be used for things like USDC and Tether. And so Tron is starting to gain share. And just this week, actually, Algorand announced that they will be a platform for the USDC stablecoin, which is a joint venture between Coinbase and Circle. So we'd expect that this infrastructure will continue to evolve and that, Ethereum 65%, we'd venture to guess that that would be quite a bit lower a few months from now. Now, the other interesting thing is that US dollars are really the lion's share of the fiat currencies that are represented in the form of stablecoins. And I guess from one perspective, it's not surprising in the sense that there's an insatiable appetite for dollars internationally. Now, we've seen this, especially through the past few months as the money printing machines have been on, that the dollar is really the apex predator of sovereign currencies at this point. Now, what will be interesting to see is how this mix evolves as Facebook's Libra project launches in the coming months. And our understanding of that project is that there will be other fiat currencies represented on chain as a part of that initiative. And so we'd expect that the dollar dominance of these platforms will wane a bit, but still remain the dollar dominant fiat currency.
So we made an interesting comparison here, which some of you may deem illegitimate, but effectively what we've tried to do is contextualize the growth of crypto dollars relative to the monetary base of sovereign nations. So if you consider crypto dollars in the aggregate as if it's a single virtual nation of crypto land, that money supply, it's about $20 billion as of today, is greater than the local broad money supply of 86 countries. And this is data which is up to date as of today. So even though we're only talking about $20 billion of monetary base, that's already outstripping almost half of countries worldwide. Iceland, Mongolia, many countries in Africa. So this is a pretty startling realization. Of course, crypto dollar is only about 10 basis points of the US broad money supply, which is closer to 20 trillion, but they have already outstripped a bunch of sovereign currencies worldwide. And we're going to get into the implications of this a little bit later, but this is what we keep hearing from central bankers. They're not really concerned about Bitcoin. Perhaps they should be, but they're not. What they are concerned about and what they make statements about frequently is the loss of monetary discretion from unencumbered dollars entering their countries directly through kind of a retail channel, and those individuals engaging in currency substitution. So that's kind of what central bankers are pretty nervous about these days. And I think at a certain point, we're going to reach a scale where they have very good cause to be nervous. So just looking at some more data, and of course, the beauty of public blockchains is they're fully auditable, and all of that data is available for any third party to pull from easily. Crypto dollars are settling about $5 billion a day in transactional value. So not only have they increased their float and their monetary base to about $20 billion, they're turning over a quarter of that float every single day. And as I'll demonstrate shortly, that's really a very high level of monetary velocity that we don't see in other payment systems. And of course, a lot of the growth is attributable to DeFi catalyzing kind of high interest rates and lots of borrowing opportunities in the crypto industry in particular starting this year. But a lot of this growth we hypothesize is just a secular demand for dollars globally. And for a neutral, kind of value neutral payments rail, which isn't volatile, which you can use to settle trade receipts internationally or send remittance internationally in dollar terms, but on crypto financial infrastructure, which fundamentally lets you do a lot more than kind of generic financial infrastructure, which is kind of heavily politicized and comes with a lot of constraints. So from under $1 billion to start the year to about $5 billion a day in final settlement on chain. And we're not counting exchange transactions here. We're counting transactions that are settling to the blockchain where we consider settlement to actually occur. So if you benchmark it against other kind of native unit cryptocurrencies, you get something incredibly interesting. So Bitcoin was the king for a long time in terms of settled value on chain. But since about 2018, Tether has been growing almost linearly and taking market share from Bitcoin, from other cryptocurrencies. And today, Tether is actually the largest single entity, and if you count it by transaction value, when you compare it to other native unit cryptocurrencies. So Ethereum has historically been quite big as well, and it's grown its market share recently. But the big story here is actually the dollarization of blockchains themselves. Crypto dollars are actually now pretty much the dominant way that people transact on chain if you measure it by values settled every single day. And this is a pretty dramatic change, we think. And it coincides with the dollarization of exchanges. Previously, Bitcoin was the most dominant pair, and now we see Tether is a very popular pair. And this is a 2020 phenomenon almost. It's really accelerated in the last year. So it's fascinating to see this revealed preference from users of crypto infrastructure. They just happen to prefer dollar-denominated tokens. So they like the risk profile of dollars, but they like the lack of encumbrances that tokens give them. And just to dig into it in a kind of even more sophisticated way, we created a scatter plot here to try and depict the transactional nature of cryptocurrencies generally. And we've called out crypto dollars in red. So the x-axis has the aggregated transaction value over the trailing 12 months. The y-axis has the actual market cap of the asset. And unsurprisingly, there's a positive correlation. If the asset has a higher market cap, odds are it's doing more transaction value. That stands to reason. But if you draw a line of best fit through this, you see that all of the crypto dollars are below the line of best fit, which implies that per unit of market cap, they're doing more transactional value than generic cryptocurrencies. So structurally, they're distinct from standard kind of native unit cryptocurrencies, which is a really fascinating finding. And we were pretty blown away when we first plotted this. So another way to say this is that crypto dollars fundamentally have a high velocity. And I wanted to compare it to a traditional payment network, not just other cryptocurrencies. So I'm using PayPal as the example here. PayPal has a float of about $31 billion. That means users have a float. They hold kind of accounts payable on the platform of $31 billion. That's not too far from crypto dollars, which is about 20 billion. PayPal is doing an annualized payments volume of about 800 billion a year. Crypto dollars are settling more than twice that, but PayPal has a much larger base of accounts and a much smaller average payment size. So this really shows you the difference. Your typical Tether payment is about $16,000, and there's only a couple million addresses on chain that have ever used a crypto dollar or that actually hold a balance. So this really shows you the distinction between the two systems. PayPal is a more retail-focused payments network with recourse, and crypto dollars are more akin to sending bank wires because you're getting final settlement with every transaction. So the kind of float numbers are similar, but the settlement and the average payment numbers are really distinct. So I think this is quite revealing. And so again, just to drive the point home, here we've plotted the typical transaction size and the number of transactions made per year for a whole variety of settlement and payment networks. And you can see that there's this kind of inverse relationship for the traditional networks with obviously these larger kind of, these larger Fedwire systems and clearinghouse systems being on the bottom right of the graph, and then cash, lots of transactions, but they're all relatively small. Now, crypto assets are kind of in the middle. They're sort of undecided, with Tether being having larger transactions typically. The question is, can they scale by increasing their transaction count? I think there's really difficult and hard to surpass constraints in terms of on-chain scaling, but they could in theory scale by increasing the transaction size. And in practice, that's kind of what we've seen over the last year or so. So we wanted to highlight some of the factors that we thought were driving adoption of crypto dollars worldwide. So this chart shows, it's a heat map showing inflation rates globally, and this is current data. And you can see that, the most inflationary countries are the ones you kind of expect: Venezuela, Argentina, Sudan, Iran, Turkey, Lebanon, etc. And this correlates to a certain extent with the places that crypto and crypto dollars are actually being adopted, because now the crypto financial infrastructure exists to allow people to get exposure to these digital assets. So if you look at Chainalysis, they did this great report benchmarking the highest per capita penetration of crypto usage from a variety of sources. They identified 10 places that had really high per capita usage of crypto. And some of them are places where there really is high inflation on a structural basis. So Venezuela, naturally, Colombia, because there's lots of Venezuelans living in Colombia. Nigeria has fairly high inflation. So too does Ukraine. These are places where the local currency just fundamentally isn't very reliable. And so the users here are engaging in currency substitution and choosing through digital assets to find alternative currencies. There is another explanation for why there would be structurally high crypto adoption in these places, even if inflation is low. You'll notice places like China has fairly low inflation, so does Russia. In those cases, it would be the existence of capital controls. And what crypto assets allow you to do is route around those capital controls and take ownership over your assets and take personal responsibility for them, essentially. So in China and Vietnam, there are recent capital controls. China, there are current ones. Ukraine has one of the most restrictive capital control regimes in the world. And of course, Russia has historically had some capital controls. So through these two variables, we can actually explain where there's adoption of crypto dollars on the ground. And this is a reference for the Chainalysis Global Crypto Adoption Index with those same data points.
So I guess the logical question here is, so what? We've demonstrated that US dollars moving on blockchains, and to some extent other fiat currencies moving on blockchains, is a big use case. But what are kind of the implications here? We'd argue that this is just a much more significant implication than something like a new Fedwire system being introduced or a new form of SWIFT. So Nick, let's talk about some of these. So I would argue, and I'm curious to hear your thoughts, that we will start to see collapses of weaker fiat currencies and in fact dollarization of non-US countries as a result of individuals being able to really just opt into having US dollars on mobile phones for the very first time. So in countries where there is high inflation and there might be a propensity to just spend on hard goods once you get your paycheck to counteract some of that inflation, really this is a way to spend on US dollars and to just hold dollars as your savings mechanism. What do you think of this?
Yeah, I think a lot of Bitcoiners expected that we would see Bitcoinization. And to a certain extent, Bitcoin is a liquidity pool which facilitates exchange, especially the peer-to-peer exchanges against local fiat currencies, which allows for that dollarization to occur. But I think the real analysis here is Bitcoin as that bridge currency and that non-state liquidity pool, which facilitates this crypto dollarization. And already in certain places, we are seeing the uptake of crypto dollars, in particular in places like Venezuela, which is undergoing an actual dollarization right now. So I know it's just
a little bit more about that Venezuela use case and maybe AirTM and Value and some of the things that have been going on over the past few weeks there.
Yeah, there's a number of startups in Venezuela which are targeting and trying to give people access to crypto dollars. Value, which creates a synthetic dollar based on a Bitcoin reserve, would be one, and it's a PayPal-like experience. AirTM and Uphold, they are targeted based on remittances, but they also are tightly intertwined with crypto markets. The reason that these work, where banking infrastructure doesn't work, US banks can't really have a relationship with Venezuela because compliance is so difficult. These work because there are local peer-to-peer markets that are extremely hard to regulate, that are based on stablecoins and in particular Bitcoin. And those markets face off against the local currency and they act as an exit valve. And then the other feature which is present is that you can own your asset on a mobile phone. Mobile phone penetration is almost 100% Venezuela. They have a highly digitized economy. Even prior to the dollarization, most banking was done online there because cash had become impractical. So it was kind of perfectly tuned and set up for this digital dollarization to occur. Now, most transactions are settled in physical dollars, in Venezuela still, so in actual Federal Reserve notes. But as these solutions go to market, I would expect that we would see more of a penetration of crypto dollars, which is a pretty exciting phenomenon.
The other thing I think that's really exciting is just the ability to have frictionless commerce, and particularly for labor markets. So if you think about some of the use cases around paying freelancers, let's say you're a company and you want to have a logo design or something simple like that, even USDC and some of these other stablecoins are actually just a better way to get those payments done. You don't need to interact with the Fedwire system. You don't need to deal with corresponding banks. And it's just a permissionless way to send that capital. So are you bullish on this being a use case for stablecoins over the long term?
Absolutely. And we see venture deals settling in USDC all the time. So that's a way to effectively send the equivalent of a wire on a weekend or outside of core banking hours. So the interesting consequence here is that now it's much easier to run a business with your balance sheet denominated in crypto dollars and conduct your accounting in crypto dollars and unify everything in a single currency and a single payments method. The effect of that might actually be that it becomes cheaper and easier to outsource professional labor and white collar labor outside of the developed world. So it could have this flattening effect on global labor markets, which would be a really interesting consequence of this.
And to be clear, we're not saying that these would be anonymous payments by any stretch. Largely, it would be the exchanges and the just crypto asset infrastructure brokerage companies that would be providing some of the on-ramps to these experiences. And so you can really imagine this coalescing nicely. Nick, is that you moving the mouse around, or is that me?
That's me.
You can see this coalescing nicely with existing infrastructure. So, we don't mean to suggest that this is going to operate entirely outside of the purview of the regulators. In fact, it seems to fit quite nicely with existing regulation.
Yeah, and I think one of the last big features here is just a loss of monetary sovereignty for some of these weaker central banks. And it might be a combination of Bitcoin and other virtual commodities and crypto dollars, or just solely crypto dollars. But I think this view that Bitcoin is going to destroy the dollar is a little bit wrong-headed. If anything, I think it's going to be mutualistic and supportive of the dollar's value, because Bitcoin effectively allows for these dollars to be imported globally. And my guess is that 10 years from now, there are going to be many fewer distinct sovereign currencies than there are today. It just won't necessarily make that much sense to be a monetary sovereign and try to constantly fight against this outflow from a weaker currency to a stronger currency.
And I would argue that the capital control side of this, we've really seen Tether establish strong product market fit around individuals in China trying to get money out of that country. Would you agree with that?
Yeah, and Chainalysis have some good data on this. I mean, they found that Tether was responsible for $50 billion worth of transactions in China, presumably mostly flowing out as a way to get out of the renminbi and into offshore assets, whether they're staying in Tether or they're using Tether as a funnel to get exposure to property or other financial assets outside of China. So whenever capital controls exist and barriers to commerce exist, that's where these crypto dollars start to thrive. And of course, China may not like that, and general regulators globally may not like that. But the fact of the matter is that these things are incredibly difficult to suppress because, again, ownership is mediated through this private key infrastructure, which is completely decentralized. Now, obviously, the key touch points are the banks and the custodians and the administrators of these systems. That's why Tether is so thorny, is because it's mostly based on offshore banks.
And that's, I guess, my last point here on this slide, at least, is just this is extensible infrastructure. So if you think about the build out that's already happened, this growth that we've seen in stablecoins is purely as a result of crypto asset infrastructure being built out. So the protocols, the exchanges, and the brokerages and the custodians primarily. But now that this infrastructure is laid and you start to see more and more market participants, more traditional firms moving into the space, more of the fintech companies trying to offer stablecoins, they're all being deployed on this common public blockchain infrastructure. And so it's massively, massively to the benefit of other types of assets that are issued on these chains. And so, a good deal of these crypto assets, these stable coins, are issued on Ethereum, for instance. And so that same architecture can enable Ethereum-based transactions. It can also enable fractional ownership in different real-world assets that are traveling on the Ethereum blockchain, non-fungible tokens. There's just a plethora of other types of assets that are extensible now that this infrastructure is widely deployed. So I really see this as massively beneficial to just other types of assets that will live on these chains, Nick.
Yeah, and if you just, what you notice is the cycles of acceleration as infrastructure is built out and it facilitates application go to market. So it took Bitcoin a long time to reach $1 billion in market cap. It took Tether a fairly long time to reach $1 billion in market cap. It took USDC a much shorter time because by the time USDC came along, it was more popular to use the ERC20 standard and exchanges already existed. What I'd compare it to would be the relationship between the internet and software as a service businesses. Arguably, the internet had to exist first for real large-scale software as a service business models to work, because that was your distribution rails. And in the similar vein, once crypto asset infrastructure, exchanges and wallets in particular, was ubiquitous and global, that was when it became possible to deploy these assets to hundreds of millions of people worldwide with not that much difficulty. And so that's why we're seeing this acceleration in stablecoins. The infrastructure already exists now.
So let's talk about where we see some of the biggest opportunities. Presumably we have a lot of investors listening in. And it's not like talking about Bitcoin, right? Because the takeaway here is not go buy a bunch of dollars because they're going to live on blockchains. Obviously, that's not an investable thesis, and holding dollars might not be a great idea. But if you think about where the value will accrue, if you believe that this use case will continue to evolve, we really see a number of categories, probably 6 in particular, that are already starting to see just massive benefit here. And so let's talk about the first one, Nick, around just brokerage and lending. And representative companies are the logos here. So BlockFi, the sponsor of this event, would really be the textbook example here of a company that's harnessed the brokerage ability for public blockchain assets like Bitcoin and Litecoin and Ethereum, but have also been at the bleeding edge of being at the center of the market structure for US dollar-based assets. And these lending markets are just now evolving, where folks can earn interest on these types of assets. So brokerages and lending firms are really poised to achieve significant growth if you believe that this phenomenon continues.
Yeah, and if you look at the brokers, they sit at the intersection between these crypto asset markets and these applications specifically, and the local sovereign currencies, the local fiat markets. And if you believe that a much larger fraction of the world's assets are going to move into this natively digital space, then you most likely believe that if you can capture some of that flow, you're going to accrue significant value and have success. And so that's the brokerage thesis. I think it's been the most successful thesis in terms of value capture and accrual in the history of the industry. And I don't believe it's going to change anytime soon. We're just seeing this monetization of a new asset class. And that's why the brokerages have historically done well and will probably continue to do well.
Yeah, I think about the brokerages as the ISP equivalents for this industry. So the brokerages are really bringing the users onto the network for the first time. Now, once you get onto the network, you start to talk about some of these other categories here around trade execution and data. Probably the most exciting thing, if you think about this in the context of the types of companies that are winning right now, it actually has tended to be a number of the upstarts, because a lot of the traditional participants, the banks and the broker-dealers, have not built out this infrastructure yet. And so there's some very real reasons why they haven't. A lot of the banks have been looking for OCC clarity, their regulator of record, on whether or not they can hold these assets on behalf of their customers. That actually came a couple of weeks ago. Well, actually, that was this week. Time flies in crypto. But the OCC put out a letter basically saying that banks could do business with stablecoin issuers. So that should open the aperture a little bit more. But if you think about these assets, you do have some fundamental capabilities that exist in equity markets, fixed income markets, around trade execution and getting data off of these platforms from a market data perspective, as well as just a forensics perspective. So, we see this as a pretty big opportunity, Nick.
Yeah, and as we've said before, the interesting thing about these assets is that they're natively auditable. They exist on chain. Those ledgers are fully transparent. Obviously, the IRS is taking advantage of that. But just more generally, you can draw fascinating and enormous amounts of macroeconomic data, a lot of which we've shared today. That data is not actually something that is available for instance, M2, any of those measures of the broader monetary base. It's not available to that same granularity. So you can't account for every single dollar that exists. The Federal Reserve doesn't really know to the nearest billion how many euro dollars exist, for instance. But we can know down to the last single dollar how many stable coins exist out there in the wild. So you have a much stronger auditability function there, which is just, it provides for a wealth of information. And I know in some cases, people promote it as both a bug and a feature. It's not as good for individual privacy, and hopefully we do enhance the privacy profile of some of these assets. But it does mean that it's an amazing bounty for analytics companies that are just trying to understand these digital economies. And there's a whole bunch of them out there.
Yeah, just to build off of that, I mean, I think participating in this category appears to be optional at this point for banks and broker dealers, but it's really not. I think when history is written on this, there will be a lot of comparisons to the internet versus the intranet. And, I remember a lot of the fears around exposing customer data to the public internet for the first time. But really choosing not to participate in this system is really just shutting off a broad swath of customers. And this is really just an open source payment network at the end of the day. But some of the things that will be required in order for those institutions to actually get comfortable with this would be things like compliance and forensics, some of the tools that Chainalysis and Elliptic, CipherTrace, some of the other large compliance firms are offering, just around tracking the flow of funds and making sure that customers are not engaging with nefarious activities and then transferring in ill-gotten gains onto the platform. So we see that as a big opportunity.
And the last big category, and I think this is where some of the history defining companies are going to be built, would be any of these entities which make transacting with crypto dollars easier for end users and serve as that interface for people who don't necessarily want to touch private keys directly, but they still want the properties that come with crypto dollars. So they want global financial services. They want to tap into those pools of liquidity, but they want to do it in a way that resembles their traditional fintech experience. So I think we're going to see lots and lots of these crypto native companies that resemble fintechs. They give you the qualities of fintechs. They might give you a yield. They might facilitate remittances, all kinds of other lending services on a cross-border basis, in particular, facilitated by crypto financial infrastructure. And they do so more cheaply because there's fundamentally less intermediation than your established remitters, than your established fintechs. And they give you access to denominating your savings in potentially the dollar, in a currency that maybe you don't have access to with the banking system in your local country. So one example would be Value, which, as you said before, creates synthetic dollar exposure through Bitcoin and through these local Bitcoin markets in a variety of countries, Latin America. But I think this is just going to be fundamentally an enormous category. I think it's going to be incredibly disruptive because we're talking about bringing dollars in a permissionless way through crypto infrastructure to potentially millions of individuals worldwide. And if given the choice, a lot of those individuals are going to desert their local, more inflationary currency, and they're going to opt into this alternative system.
I think the most important thing of what you just said there is just the simplicity and really just making it dead simple for users to engage with these platforms. This has the ability to be a technology that no user really needs to know what's happening below the hood if they don't want to, right? So whether or not this is a stable coin moving on the Algorand blockchain, the Ethereum blockchain, it doesn't really matter as long as it works. And we're not going to be in a world where an everyday user is engaging with a block explorer and looking at time to settle on the base level blockchain. All of that will be kind of obfuscated, just like how people don't engage directly with TCP/IP or HTTP these days. They use web interfaces, mobile interfaces. So that's really the promise of some of these savings technology companies that are coming along and just making it easier to move money.
So we have written a white paper about crypto dollars, which was published in June, although Unfortunately, it's kind of out of date now because the crypto dollar market is moving so quickly. At least some of the charts are out of date. But we do cover more about the business models in the category if you're interested in trying to figure out how to invest in the crypto dollar opportunity. Of course, you can't really buy the protocols themselves most of the time, but there are lots and lots of really interesting business models that we think are super promising. We disambiguate, there's a taxonomy. We cover the 28 largest crypto dollar projects, talk about our own thesis in the space. So that's castleisland.vc/crypto dollars. It's basically a much more comprehensive version of the talk we've given today. It's free on our website.
We'd love to open it up if we have any time for questions from the audience.
We have about 5 minutes here, I believe.
Yep, about 5 minutes. Hey guys that are watching at home, refresh your page, please. The chat switched over from one system to another. So please, if you have your browser open and know how to refresh your page, go ahead and do that. And then use the chat box that you see at the bottom of your window to drop in questions. So I was wondering from you guys, while we're waiting for chat to switch over to that other system, I have a question for both of you. What is the most, I mean, both of you are very entrenched in cryptocurrency. You're absolutely experts. You are speaking with, profound authority on the topic. But I'm curious, where does that passion come from? What was that aha moment where you said, okay, cryptocurrency is definitely the future. I need to get into this. And Matt, I want to start with you on that.
Yeah, so my path was, originally I started getting into Bitcoin. And to me, the aha was just the ability to send an asset peer-to-peer without a trusted third party. And I had some knowledge of how the existing settlement systems work for securities. And so I was initially actually drawn to it as a financial technology before I was drawn to it as a monetary good. And I guess as you go through the sort of learning journey here, it forced me to understand things that I did not understand very well, ranging from computer science to Austrian economics to actually how money works. And so over time, I'd say I've gravitated more towards seeing Bitcoin specifically as a savings technology and seeing some of these other applications around crypto dollars really as just an open source payment infrastructure for the internet that anyone in the world can participate in. And so now I sort of see it in, I call them tribes. And so I think that there's the money tribe, there's the tech tribe, and then there's maybe the traditional securities, digital assets tribe. And, I kind of like them all, to be honest with you. I think there's an extensible infrastructure there.
Yeah, I like how you've divided that into three principal segments. The way you stated that makes a lot of sense. I too like them all. I'm very much looking forward to this new decentralized utopia where we're flying around on Bitcoin-based cars, and as well as the ride along the way where we're hopefully making some money on some astute investments. Nick, the same question to you.
Well, I guess I've always had pretty direct political inclinations as far as it concerns cryptocurrency. I've always been a supporter of the underdog and the little guy, and I've always kind of rejected authoritarianism, and I see this as fundamentally an anti-authoritarian technology. And if you look at the way that it's being used in the world today, it's used to protect dissidents. Of course, there's a dark side to it, which is that people can use it for tax evasion and other nefarious purposes, but fundamentally you have to take the bad with the good. And what we're doing is separating state power from the wealth and the monetary assets of individuals. And I think that's a profoundly important phenomenon, and that's why I support the asset class.
And there are some political radical wackos out there that see a global trend toward authoritarianism. I don't know where they would get that idea, but to those folks, would you say that those trends are perhaps accelerating the adoption of cryptocurrency?
Yeah, absolutely. And as we talked about a little bit, whenever capital controls and restrictions and monetary repression in the form of very deep negative interest rates, very deep real negative interest rates, or very high inflation rates, which are interrelated, whenever those exist, people are going to flee to hard assets, and they're going to flee to hard assets that they themselves can custody and own. And historically, gold was the hard asset of choice. And now we have kind of an upgrade on that. So it doesn't surprise me that it's accelerating the move towards crypto.
Love it. An upgrade on gold. So now that folks have refreshed their windows, the latest comment is, wow, from Emmanuel. I want to thank Emmanuel for that. I'm not sure if that was directed toward Matt or perhaps Nick. Hello, Castle Island. We got an insurance agent from Cali who simply loves you.
We love you too.
So there you have it, Kevin. Right back at you. Guys, thank you so much for your time. That deck is so freaking interesting. I want it so I can pour over it this weekend while I have, I don't know, perhaps a Chardonnay. I think it's probably a good one to pair with that macro level data. I really appreciate having you both here, Mr. Matt Walsh, Nick Carter. Where can folks find more from you on the internet?
Follow us at castleisland.vc, and we're also on Twitter, and DMs are open.
There you go. DMs are open, guys. Slide in there. Thanks so much, guys.
Thanks, Neil.
Thank you. Thank you.
Have a good weekend.